The Fed's recent interest rate cut and the expectations of more to come has become a boon for Wall Street, as well as volatility last quarter, sending trading revenue higher for the big banks. Here with more, we're joined by Scott Sperling, THL Partners co-CEO here. Scott, thanks so much for joining the program here this morning. And certainly, as we're thinking about the impact of the rate cuts and the policy pathway, and how Wall Street is really factoring that into the trading outlook, how are you looking at this and the perhaps pathway for some of those additional rate cuts that Wall Street is trying to price in?
So if you take a step back in the big picture, rates are not high relative to historical averages. They're high relative to the extended period of basically free money that we had, but they're not particularly high relative to either the last 20 years or certainly not the last 40 or 50 years. So I think we're in a reasonable range as we sit today. The expectation for lower rates, I think, is mostly affecting the way that Wall Street might discount the value of future cash flows and therefore look at whether or not the multiples that we're seeing companies trade for today, whether that's reasonable or not reasonable. I don't know if we're going to have a significant uptick in economic activity if we see another 50 to 100 basis points of rate cut at this point. It may have an impact on things like the mortgage market. It will have an impact on what is already record high levels of credit card debt for people, potentially. But those rates are already so dramatically high that even a cut in the base rates may not make that much of a difference. And I think as we think about longer term discounting of the value of cash flows of a given company, one of the things that we certainly have to look at is whether or not the Fed always retains control of what that 10-year and 30-year number looks like, given the amount of debt that we're running up and the amount of debt that needs to be refinanced over the course of the next 5, 10, and certainly 20 years.
And Scott, with all that taken into, and it's good to see you, with all that taken into consideration and trying to figure out maybe what the next couple quarters are going to look like, I'm just curious from your perspective, from the mixed data that we've been getting out, from the fact that we did see the Fed cut by 50 basis points at the last meeting. Now there's talk of no cuts at the next meeting. How confident are you that we're going to see some sort of soft landing orchestrated?
You know, I have hope like everyone else does. Now, that hope defies all of our history where there's really never been a soft landing. I think you have to look almost sector by sector. I have had people who are CEOs of companies in industrial sectors who will tell you that they've been in a recession for the last 18 months. So not sure how soft it is for them. Now, interest rate cuts also are probably most helpful for those kind of capital intensive businesses. Tax policy certainly will play a role in that as well as we look past the November elections. But for much of the rest of the economy right now, there's this mixed feeling that, yeah, it doesn't seem to be that bad, but underlying key metrics are sometimes problematic. And I think that's what the Fed is looking at as they think about reducing rates. Now, I would say that it may be prudent to say, let's take a little bit of a pause here, see how those underlying metrics evolve over the course of the next 6 months, and then make some judgments about the intensity of the rate cuts that we want to put in place.
So, Scott, how are you factoring that into your strategy? I know you recently bought a majority stake in AMI. It's a semiconductor software firm. As you're trying to identify still attractive opportunities within the market right now, with that in mind, with that uncertainty, what's your checklist, or what are some of the things that you are keeping top of mind at this point?
So, you know, we've long said that our focus is on opportunities where we believe that there are strong, sustainable, secular growth drivers that tend to be less capital intensive businesses. And so it's not that companies we buy may not be affected by the economic cycle, but they tend to be less affected. And we're really looking for more very long-term growth drivers that provide significantly greater than GDP growth. So I would say that we're not concerned right now about the near-term cycle that's going to happen in terms of the things that we're the kinds of companies we like to buy. On the other hand, you know, reading some of these secular growth waves is a very important element in the decisions that we make. and then thinking about where valuations are today relative to where they might be in 5 years is a major exercise that we try to go through, looking at what the growth for the next buyer might be.
And so with that in mind, how are you gaming out what that could look like under either administration, as you've got to take into account what the M&A activity and landscape looks like, as you've got to take into account what tax rate and that policy looks like, and all of this impacting some of the investment thesis, knowing that some of those dollars will flow through from whatever that administration's agenda is, and who do you see as being better for some of those investments, either for the equity market side or an economic side and that lens as well?
Well, certainly the regulatory environment writ large is a major factor, we think, in driving or constraining economic growth going forward, because it just adds significant cost to doing business in the country. So reasonable and rational regulation, I think, is very important to do. Having over-regulation really disadvantages American businesses, and is something that we have to look very closely at, given the nature of the companies that we're buying. And that extends to the nature of the antitrust regulation as well. So, that would be number one, if you will, on my list. And partly number one because, neither party is advocating for significant efforts to reduce our national debt, let alone our annual deficits in the near term. I do think what will be important, and what we have seen historically, and you can go back to the Clinton years and even the Reagan years to see how it's really growth that allows you to deal with these overwhelming deficits that we're running and national debt buildup that we're seeing. And so you have to look to see which candidate do you think allows for greater long-term growth, if you think about it in that way.
Scott, as you're taking a look at deficits, I guess, real quick, two-part question here. One, what's the impact of capital spending, do you think, in the near term, given the fact that we could see ballooning deficits? And then two, what do you think it's going to take, just as you're evaluating this situation right now, what's it going to take for either side to address this issue?
Well, in terms of capital spending, again, tax policy, and that's probably where interest rates might play a role. How significant, it's not yet clear, but will play some role, at least on the margin. And then overall demand, which is really driven by growth. I think if you look at the consumer's been heroic for a large number of years. During the COVID shutdown, people weren't spending at all. Savings were growing. That was dramatically enhanced by checks people received. But all of that, as we know, has been paid down and more. People got used to spending again. And so now you have record credit card levels for much of the population. So anything that can ease the burden on the consumer will be very helpful to drive overall capital spending, because you still need that fundamental demand no matter where interest rates are. And if you look at the impact of inflation, clearly the cumulative 20% inflation, 20% plus, and in many consumer-driven items, whether it's housing, energy, or food, you often see much higher than that cumulative 20%. That's really taken a big bite out of the demand in terms of the volume of things that people can afford to buy. So getting back to a point where you believe that inflation can return to that 2% mark that the Fed has set is very important in terms of allowing the consumer to catch their breath and reestablish significantly more demand that will flow through to capital spending.
Scott Sperling, always great to have you. Thanks so much for taking the time to join us here, Scott.
Thank you very much.
THL Partners co-CEO. Appreciate it.